if this property market, the recession should have led to, a lot of people's thinking, it should have led to a substantial fall in house prices, and if your security is the value of a house, you potentially could have been at risk. What are you seeing for house prices at the moment?
Well,
you'd be watching them.
We're watching it very, very closely. What I think generally the consensus of the market is at the moment, I think everyone is quite surprised in relation to how resilient property prices are. So, as we discussed last time we were on the show as well, it was 0.5% nationally. The capital values have fallen. The figures came out last month as well. It was less than 0.5% for that particular month. So for property prices are very, very resilient, but we're not to say that it will continue to fall over time until the economy is back on its feet, until we get out of, obviously we don't know the true essence of this is that we don't know the true damage of the economy at the moment, because we've got JobKeeper. We don't know how many zombie companies are out there. So we see zombie companies all the time. But
you
we
love
don't lend to
saying
them.
zombie companies.
Yeah, well.
They're unbelievable.
But we don't know the extent of them. And so the multiplier effect of these zombie companies not being able to employ their staff going forward, there will be an adjustment period.
But you must have been happy when you heard the IMF tip our contraction would be at what, 4.5%, the second lowest contraction in the world behind South Korea. That's a good thing. And also we expected to rebound 4%. Of course they're guessing, but at least the guessing is all looking favourable for us. And therefore it justifies what you're saying, recession. What recession when you compare it to the 90s? People watching this would be thinking, do you think that the outlook for this market, and of us, other people in this program, when we come into spring, if we do see the economy doing okay without JobKeeper and without an elevated value of JobSeeker, that there'll be a lot more properties put on the market and the market will be healthier than it is now?
Well, what we're seeing already the last 2 or 3 months, there's a bit more confidence. So therefore, during the lockdown, we had, I think the amount of properties in Sydney that were at auction were about 250, 300. Now it's actually ticking up in the mid 500s, but the clearance rates are still staying around between 60 and 70%. That sort of shows that there is the healthy mechanics of the property market. What we need to acknowledge as well is that what we had in Sydney and Melbourne, more particularly, overnight we had an undersupply in property, and then the day that we had the lockdowns, we had an oversupply. And let me explain the mechanics there. Is that in Sydney we had 127,000 apartments that were permanent Airbnb apartments that went on a permanent rental market. We had nearly 500,000 students. Now I don't know how many of them have gone back overseas or stayed here. We don't have tourists at the moment. So we have all of this property infrastructure that are designed for student temporary visas that now are being absorbed for permanent market. So I think that we will still see a bit of a decline. I can't see the uptick. There is more confidence in selling your property at the moment. But what I want to see is also how the students are going to come back to Sydney, Melbourne, and the rest of the states.
It's like a temporary structural change. I do know, and you might have the same information, that in some tourist areas where properties were not being rented Airbnb, they're now being booked out night after night. So there's going to be a lot of internal travel that will probably help with those Airbnb, but you're right, it seems like there will be an oversupply of rental properties and therefore rents will be down and prices should go with it.
And it might be a little bit of an adjustment, but then you have to look at the difference between investment stock and owner-occupier. So from a coalface perspective, when talking to people on a daily basis, they're saying they still can't find an owner-occupied property. So if you're in the market to buy your own personal house,
and that's the space you guys play in? Primarily the security is residential property?
Well, it could be any type of property as long as it's non-specialised. So what we really avoid is specialised security. So the reason being is that when you have a bit of an adjustment in the property market, that's where you can have the largest capital depreciation of asset. So we stay away from it. So majority of our transactions are secured by residential property, but we do industrial as well, commercial property. But where the difference between us and probably other funds as well is that people can actually choose the security they want to invest in. So there's a particular borrower, there's a set of cash flows, we've done all the due diligence, and so therefore the investor can hop in the car, depending which state they're in, and they can actually go to the property and see it, say, well, you know what, I put $100,000 towards this particular investment, and I know that property is worth $1 million, and the boys have not lent more than $600,000 against that asset. So that gives people a lot of security, peace of mind. They know they're getting the regular income every single month. We've had our phone ringing more in the last month than the last 2 years in relation to investors wishing to get more information and invest in these type of assets as well.
And